Hello, and welcome back to Boni's Life, your indispensable weekly guide through the electrifying and sometimes bewildering world of cryptocurrency. I'm your host, Boni, and it is a genuine pleasure to have you with me today. We stand at a fascinating crossroads in the market, a moment brimming with both immense opportunity and palpable tension. Over the next half hour, we will embark on a deep intellectual dive to dissect the market's performance with a laser focus on the dramatic whirlwind of the past 48 hours. This isn't just about numbers, it's about understanding the story those numbers tell. We will meticulously unpack the technical charts, revealing the hidden patterns and signals that professional traders are watching. We will also connect the dots on a global scale, exploring the fundamental macroeconomic and geopolitical events that are pulling the strings of this multi-trillion-dollar market. And as always, we will bring in the heavyweights, the sharpest minds from the worlds of trading, development, and regulation to get their unvarnished perspectives. My goal is to equip you with the knowledge and clarity you need to navigate these markets with confidence, whether you're a seasoned veteran or just starting your crypto journey. So, pour that coffee, silence the distractions, and let's get into it. All right, let's begin with the 30,000-foot view, the state of the entire digital asset ecosystem. As of this morning, October 3rd, 2025, the total cryptocurrency market capitalization is holding strong at a staggering $4.22 trillion. To put that number into context, it's larger than the entire economy of Germany. We've seen a respectable 1.4% increase in just the last 24 hours. Now, in the world of traditional stocks, a 1.4% day is a great day. In crypto, it's a signal of steady, confident momentum. What's even more telling is the daily trading volume, which has surged to $193 billion. This isn't passive sideways movement. This is active, engaged capital flowing through the markets, indicating a high degree of conviction from traders. But what is the mood of these traders? For that, we turn to one of my favorite tools, the Crypto Fear and Greed Index. Right now, the needle is pointing to 57, which is firmly in the greed territory. This is a significant shift from just yesterday when it was at 51, and a massive leap from the fear level of 34 we saw just 5 days ago. This index isn't just a whimsical gauge. It's a composite of multiple data points, including market volatility, volume, social media sentiment, and dominance. A score of 57 tells us that FOMO, the fear of missing out, is beginning to creep back into the market. Investors are becoming more bullish, more willing to take on risk, and that can be a powerful self-fulfilling prophecy. The bears, who had a brief moment in the sun, are now in retreat. Now, let's zoom in on the undisputed king of this digital kingdom, Bitcoin. BTC has been the lead actor in this week's drama, confidently striding past the $119,000 mark and is currently trading around $120,000. This isn't just a random number, it's a psychological milestone, a level we haven't seen sustained since the highs of August. This powerful move has propelled Bitcoin's individual market cap to an astonishing $2.37 trillion. I said this earlier, but it bears repeating. Bitcoin, a decentralized network of code, is now more valuable than Amazon, one of the largest and most influential corporations in human history. If that doesn't tell you a paradigm shift is underway, I don't know what will. So, what's the fuel in this rocket? The narrative is a compelling blend of fundamental strength and technical validation. Fundamentally, the October phenomenon is in full effect. This isn't just a catchy phrase, it's a statistically significant trend. Since 2013, October has delivered an average return of over 14% for Bitcoin. Traders are well aware of this seasonality, and it creates a positive feedback loop of expectation and buying pressure. More importantly, the institutional floodgates are well and truly open. The recent approval of spot Bitcoin ETFs was not the end of the story. It was the beginning of a new chapter. We've now seen 4 consecutive days of net positive inflows into these ETFs, with a jaw-dropping $627.24 million pouring in on October 2nd alone. Financial titans like BlackRock and Fidelity aren't just dipping their toes, they are leading the charge, making it easier and safer than ever for institutional capital, pension funds, and endowments to gain exposure to Bitcoin. This is sticky money, long-term allocation capital, and it's creating a powerful supply shock by taking coins off the market. Now, let's get our hands dirty with the technicals. Looking at this daily chart, we can see a beautiful textbook breakout. Bitcoin has decisively sliced through the 50-day moving average, which was acting as resistance and has now flipped to become a key support level. The Relative Strength Index, RSI, a momentum oscillator, is at a healthy 65. This indicates strong buying pressure, but crucially is not yet in the overbought territory above 70, suggesting there's more room to run. Furthermore, the Moving Average Convergence Divergence (MACD) indicator, which shows the relationship between two moving averages, has printed a bullish crossover. This is when the faster MACD line crosses above the slower signal line, and it's a classic buy signal for trend-following traders. However, we must remain objective. We are now approaching a formidable wall of resistance at the $124,600 level. This area represents a confluence of factors. It's a key Fibonacci extension level from the previous swing low and the site of heavy selling pressure in late August. A decisive close above this level on high volume would be an incredibly bullish confirmation, likely triggering a cascade of liquidations for short sellers and opening the door to our next major targets of $128,000 and the psychological price of $130,000. Conversely, a failure to break this resistance could see us retest support levels, first at the psychological $117,000 mark, and then the more critical support zone around $113,500. The battle for $124,600 is the key engagement to watch in the coming days. While Bitcoin may wear the crown, Ethereum is the undisputed queen of smart contracts, and she is having a spectacular week. ETH has rallied an impressive 14%, smashing through the $4,400 barrier and is currently flirting with the $4,500 level. This isn't just a case of riding Bitcoin's coattails. Ethereum has its own powerful fundamental drivers that are attracting immense interest. The most significant of these is the explosive growth of its decentralized finance, or DeFi ecosystem. Think of DeFi as a parallel financial system being built on Ethereum, offering everything from lending and borrowing to trading and insurance, all without traditional intermediaries. The health of this ecosystem can be measured by total value locked, or TVL, and the numbers are staggering. Aave, a leading DeFi lending protocol, saw its TVL jump by an incredible 70% in the third quarter of this year alone, from $42 billion to $74 billion. This isn't just speculative capital, it's active, working capital that generates real yield and demonstrates the growing utility of the Ethereum network. Every transaction, every loan, every trade in this ecosystem requires ETH as gas, creating a constant organic demand for the asset. Mirroring the Bitcoin story, institutional interest in Ethereum is also surging. Ethereum ETFs saw inflows of over $307 million this week, bringing the cumulative total to a massive $14.19 billion. Institutions are no longer just looking at Bitcoin as a store of value. They are now recognizing Ethereum as a productive, yield-bearing asset and a technology platform with vast potential. Technically, Ethereum's chart looks even more bullish than Bitcoin's. It has cleanly broken out of a bullish pennant pattern on the 4-hour chart, a classic continuation pattern that suggests the previous uptrend is set to resume with force. The RSI is a very strong 68, and the MACD is in a clear, unambiguous uptrend. But the most important chart for altcoin investors is the ETH/BTC ratio. This chart, which pits Ethereum's performance directly against Bitcoin's, is showing signs of a major breakout. A rising ETH/BTC ratio is often the primary catalyst for what we call altcoin season, a period where other cryptocurrencies outperform Bitcoin. If this ratio continues to climb, it could signal the start of a much broader market rally. The next major hurdle for Ethereum is the resistance level at $4,750. A break above that, and the path to the psychologically important $5,000 mark seems not just possible, but probable. Key support levels to watch are the previous resistance turned support at $4,300 and the stronger support zone at $4,150. As we've established, the crypto market is not an island. It is deeply intertwined with the global macroeconomic landscape. And the biggest story on that front this week is the ongoing U.S. government shutdown. This political gridlock in Washington is creating significant uncertainty. The shutdown has led to the furloughs of thousands of federal employees, including many at key regulatory agencies like the Securities and Exchange Commission (SEC) and the Commodity Futures Trading Commission (CFTC). This directly impacts the crypto industry by delaying crucial regulatory guidance and the approval of new financial products. We've already seen the SEC miss its deadline on an application for a Litecoin ETF, and there's a growing backlog of other filings. This regulatory paralysis creates a fog of uncertainty that can make institutional investors hesitant. Furthermore, the shutdown is delaying the release of vital economic data, most notably the monthly jobs report. Without this data, traders and the Federal Reserve itself are flying partially blind, making it harder to accurately gauge the health of the economy. This data vacuum naturally leads to higher market volatility. However, and this is a perfect example of the often counterintuitive nature of markets, this shutdown has a significant silver lining for crypto. The consensus is that the economic disruption caused by the shutdown makes it far more likely that the Federal Reserve will step in to support the economy. The market is now pricing in a 90% probability of a 25 basis point interest rate cut at the Fed's October meeting. A rate cut is like a shot of adrenaline for risk assets like cryptocurrencies. It lowers the cost of borrowing, encouraging investment, and it also contributes to the debasement trade. This is the idea that as the central bank prints more money and lowers interest rates, the value of fiat currencies like the US dollar is eroded or debased. This drives investors to seek refuge in scarce, hard assets that cannot be arbitrarily created, with Bitcoin being the prime digital example. This expectation of cheaper money from the Fed is arguably the single biggest tailwind for the crypto market right now. With this complex backdrop, what are the smartest people on Wall Street saying? The institutional sentiment has turned decisively bullish. JP Morgan, a bank whose CEO once famously called Bitcoin a fraud, has made a complete 180. Their latest report sets a stunning year-end price target of $165,000 for Bitcoin. Their thesis is fascinating. They argue that based on a volatility-adjusted comparison to gold, Bitcoin is significantly undervalued. For Bitcoin's market to equal the private sector's investment in gold, they calculate its price would need to rise by over 40% from current levels. They state, and I quote, "The debasement trade has led retail investors to heavily invest in both Bitcoin and gold ETFs." Citigroup is singing a similar tune, raising its year-end Bitcoin target to $132,000 and its 12-month target to an impressive $181,000. For Ethereum, they see $4,500 by year-end and $5,440 within 12 months. Interestingly, their report expresses a preference for Bitcoin over Ethereum for new institutional capital, citing its longer history and clearer digital gold narrative as being an easier sell for investment committees. Of course, a balanced view is essential. We must also listen to the voices of caution. Analysts at the crypto exchange Bitcoin have issued a warning that Bitcoin is entering a zone of heavy liquidity, which could lead to a period of choppy sideways price action or consolidation. They've also flagged the significant risk of a long squeeze if Bitcoin fails to break resistance, highlighting that a break above $121,000 could trigger a cascade of short liquidations amounting to $650 million, adding extreme volatility. And we cannot ignore the builders. Charles Hoskinson, the brilliant mathematician and founder of Cardano, recently reiterated his long-term prediction that Bitcoin could reach $250,000 by mid-2026, based on its well-documented 4-year halving cycles. This perspective reminds us that beyond the short-term noise, there are powerful long-term secular trends at play. So, after absorbing all of this information, the crucial question is, how do we translate it into an actionable strategy? The answer depends entirely on your personal time frame and risk tolerance. For the short-term traders watching, the next 24 to 48 hours are pivotal. The key levels I mentioned earlier, $124,600 for Bitcoin and $4,750 for Ethereum, are your battle lines. A decisive breakout on strong volume could be a signal to enter a long position, targeting the next levels of resistance. A rejection from these levels might offer a shorting opportunity or, at the very least, a signal to wait for a better entry on a pullback to support. In this volatile environment, disciplined risk management is paramount. Use stop losses, don't over-leverage, and consider taking partial profits at key levels to de-risk your position. For the long-term investors, the hodlers in the audience, the strategy is different. Your goal is not to time the market but to accumulate a position in what you believe to be a transformative asset class. The current macro environment, with the prospect of sustained currency debasement, provides a powerful thesis for holding assets like Bitcoin. The increasing institutional adoption provides a long-term demand floor. For you, dips are not a source of fear, but an opportunity to add to your position at a discount, a strategy known as dollar cost averaging, DCA. The key is to have conviction in your long-term thesis and to ignore the short-term noise. And let's not forget the burgeoning world of altcoins. While Bitcoin and Ethereum are the blue chips, incredible innovation is happening elsewhere. Solana, SOL, with its high-speed, low-cost transactions, is a formidable competitor and has shown great strength, currently trading at $229. Aptos, APT, a newer Layer 1 blockchain with a strong technical pedigree, is also gaining significant traction. For those with a higher risk appetite, a small allocation to these promising projects could offer outsized returns, but be aware that their volatility will be significantly higher than Bitcoin's. And that brings us to the end of our deep dive for this week. We've covered a tremendous amount of ground, from the intricacies of the MACD indicator to the complex dance of global monetary policy. The picture that emerges is one of a market at a tipping point. Bullish sentiment is building, institutional capital is flowing in, and the macroeconomic winds are at our back. Yet, significant resistance levels and regulatory uncertainty demand our respect and caution. I hope this analysis has provided you with the clarity and context you need to make your own informed decisions. The world of crypto is the most exciting frontier in finance and technology, and it's a privilege to explore it with you each week. Thank you for joining me on Boni's Life. Do me a favor and hit that like button, subscribe to the channel, and ring that notification bell so you never miss an episode. And now I want to hear from you. What is your price target for Bitcoin by the end of the year? Are you a bull or a bear right now? Drop your thoughts in the comments below. Until next time, stay safe, stay savvy, and I'll see you in the next one.